Asset-backed securities, or ABS, represent an important category of fixed-income investments. These are financial instruments backed by pools of loans that are not mortgages. Instead, they're secured by various types of consumer and business debt, including auto loans, credit card receivables, student loans, and equipment leases. Understanding ABS is crucial for anyone interested in structured finance and derivatives markets. Asset-backed securities are created through a process called securitization. Financial institutions pool together various types of debt, such as car loans or credit card balances, and then sell the rights to the cash flows from these loans to investors. Essentially, when borrowers make their monthly payments, that money flows through to the investors who purchase the ABS. This process transforms illiquid loans into tradable securities that can be bought and sold in financial markets. There are four main types of asset-backed securities. First, auto loan ABS are backed by car financing payments. Second, credit card receivables ABS are backed by credit card debt. Third, student loan ABS are backed by education financing. And fourth, equipment lease ABS are backed by business equipment financing. Each type has distinct characteristics based on the underlying collateral and borrower behavior patterns. The securitization process follows four key steps. First, a lender originates loans to borrowers, whether for cars, education, or credit cards. Second, these loans are pooled together and sold to a special purpose vehicle, or SPV, which is a separate legal entity. Third, the SPV issues securities to investors, raising capital. Fourth, as borrowers make their loan payments, the cash flows pass through the SPV to the investors who hold the securities. This structure isolates the assets from the originating lender's balance sheet. Auto loan asset-backed securities are among the most common types of ABS. These securities are backed by payments from car loans and have several distinctive features. They typically have predictable payment schedules since car loans are installment loans with fixed monthly payments. The collateral backing these securities is the vehicle itself, which can be repossessed if the borrower defaults. Auto loan ABS usually have maturities ranging from 3 to 7 years, matching the typical length of car loans. Credit card asset-backed securities are backed by credit card receivables, making them quite different from auto loan. ABS credit cards are revolving credit, meaning borrowers can continuously borrow, repay, and borrow again up to their credit limit. Unlike auto loans, there's no specific collateral backing individual credit card balances. This makes credit card ABS generally higher risk compared to auto loan securities. However, this higher risk also means investors typically receive higher yields as compensation. Student loan asset-backed securities are backed by education debt and have unique characteristics. These securities typically feature long-term payment schedules, often spanning 10 to 25 years, because student loans have extended repayment periods. An important distinction exists between federal and private student loans. Many federal student loans come with government guarantees, which significantly reduces default risk. This government backing makes certain student loan ABS lower-risk investments compared to other types of asset-backed securities. Asset-backed securities offer both benefits and risks to investors. On the benefit side, ABS provide diversification because each security is backed by hundreds or thousands of individual loans, spreading out the risk. They also offer steady income streams from the regular loan payments. However, risks exist as well. Credit risk is significant, as borrowers may default on their loans, reducing cash flows to investors. Additionally, prepayment uncertainty poses a risk, because borrowers might pay off their loans early, affecting the expected returns and duration of the investment. Most asset-backed securities are divided into tranches, which are different classes of securities with varying risk and return profiles. The senior tranche has the highest priority for receiving payments, making it the lowest risk with the lowest yield. The mezzanine tranche sits in the middle, with moderate priority, risk, and yield. Finally, the equity or junior tranche is in the first loss position, meaning it absorbs losses before other tranches. This makes it the highest risk, but also offers the highest potential yield. This tranching structure allows different types of investors to choose securities that match their risk tolerance. Let's review the key takeaways about asset-backed securities. First, ABS transform illiquid loans into tradable securities, providing liquidity to the financial system. Second, multiple asset types beyond mortgages can be securitized, including auto loans, credit cards, and student loans. Third, tranching allows risk customization, enabling investors with different risk appetites to participate in the same underlying loan pool. Finally, understanding the collateral type is crucial for risk assessment, as each asset class has unique default patterns, prepayment behaviors, and recovery rates. These factors all impact the performance and risk profile of asset-backed securities.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.